Phillip Ng, Jefferies Senior Building Products Analyst, joins us now. And you cover a lot of these names we don't talk about very often. Ferguson, Eagle Materials, Champion Homes. What's the risk-reward setup for these names from here, given we've already started to see such a boost?
Yeah, I mean, certainly the risk is that mortgage rates have actually come down about 100 basis points already ahead of the rate cut. So we need to see rates ideally below that 6% threshold. I think that's where we see consumers really kind of step into it and drive activity. But we really haven't seen that recovery come through yet. But we remain pretty bullish. I think the market's certainly underbuilt from a housing standpoint for new construction. And if you think about existing home sales, which has really been frozen with this lock-in effect, we see that potentially being a big catalyst going into 2025 for some of these renovation-related names.
So you say the lower rates that are coming aren't fully priced into these stocks?
We've seen a move. I think if we see a bigger uptick, we see legs to these stocks, and certainly that's why we're bullish and we remain constructive of a lot of these names.
What 6%? Are you basing that on historical numbers and as far as what might drive a lot more demand for home buying?
Sure. We've done some work on the consumer side. I think from an affordability level, about 80% of the consumers we surveyed back in June, that was a technical threshold where they could come back to the market and you would see that affordability level improve. And if you think about the average consumer, call it about 60-70% of consumers currently have mortgage rates below 4. 7 to 4 was a very big ask. 5 to 4 is probably more manageable, and there's been a lot of pent-up demand, people that were waiting on the sidelines, and we think life events are probably a bigger catalyst, but certainly under 6% is a threshold. We think that could catalyze activity. And the other piece on the new construction side for housing, if you think about a lot of the regional builders, which make up about 60% of the market, with the credit markets tightening up, they've been really frozen from that market. The big builders have been buying down mortgages, so that activity could really drum up activity. Certainly, these stocks have rallied off the bottom when rates were really high and sentiment was pretty negative, but we still think there's room to go.
Phillip, is there any sense that the spread between long-term rates and the 30-year fixed is going to compress, or are we sort of beholden to what the overall rate structure is going to do?
No, it's a great question. That's a million-dollar question. I think what we've seen in past cycles, when activity does pick up, that spread does narrow a little bit. When activity is weak, like we've seen the last 12 months, that spread is a little more outside. So we're hopeful that that spread does come down and it would bring rates back to below that 6% level. But I think what's encouraging is with rates coming down already, we saw the housing start data that came out today. It was certainly stronger, and you saw a nice uptick from July to August.
Who has the most upside in your group?
Yeah, so when we think about how we want to be positioned on the new construction side for single family, that will probably come back first. So the names that we do like on new construction, we're bullish on Top Build and BLDR. And in the R&R piece, which is more tied to existing home sales, it's been really, really depressed. It's been at multi-decade lows. If we see rates kind of pull back, that could, accelerate R&R activity in existing home sales. There's been this lock-in effect. So names that we like in that recovery in R&R would be Fortune Brands and AZAC.